Thank you for attending this EDHECinfra webinar of 2021 in review. In this webinar, we are going to look at some very interesting topics of how infrastructure performance was impacted last year. We'll look at some of the key risks that were visible in the performance, such as FX movements, inflation, or interest rate risk. And we'll also see how these risks will become even more important going into the next year, or this year now, 2022. So a bit about myself before we dive in. I head the product development team at EDHECinfra. I've been with the organization for more than 3 years now. And I've been heavily involved with the design and development of all the analytics and indices that I'll present to you today. So this is about the organization briefly, and I'm sure a lot of you would already be familiar with us. We started off as a research program at EDHEC Business School more than 10 years ago. And since then, we have been, there's been a dedicated research institute on infrastructure created, that is EDHECinfra. And since 2020, we have spun off this commercial venture, Scientific Infra, which is the provider of these market indices and analytics that I'm going to present to you today. So this informatics platform is where we have all these products available. And it is aimed at serving all the use cases of infrastructure investors. Let it be about benchmarking your portfolio, or about understanding the valuation of your investments, or the risks involved, or even if you are investing via a fund manager and you want to assess their performance. So our goal is basically to serve all these use cases an institutional investor has in infrastructure. And all these 4 products are currently available in the platform. And then there are 2 more products that are coming up later this year on asset ratings, which is going to be very important in understanding how the infrastructure companies fare against each other. And also we will produce these ratings on infrastructure managers. And then the next product would be the peer groups, which will allow you to compare like for like against your peers in the similar industry or similar type of geography or similar investing goals and so on. Just a brief note about our clients. So you can find some of the names of some of the large institutional investors here on the slide. In total, our clientele represents more than $25 trillion in AUM, out of which about 280 billion in infrastructure alone. So we can safely say that these products are very popular in infrastructure investors, and they're used widely across the world. A few housekeeping rules. So this presentation will last for about 30 to 40 minutes, and then we'll leave 15 minutes for the questions, and we'll also run a poll in this presentation. For the questions, you can use that, we'll use the written format, so you can use the dialogue in Zoom to post your questions. There won't be any voice comments or questions in this webinar. And finally, the webinar is also recorded. Right, so here's the agenda for today. First, we will look at the Q4 release and the different aspects of the performance. In this part, we will also touch on the performance of different segments, different components which drove the performance, and so on. Then the second part of the presentation, we'll look at the universe coverage and briefly highlight how it has changed in 2021. And then we'll also do a reminder of our calculation methodology for the valuations of infrastructure companies before we go to the part 3, where we will look at the valuation drivers, as in which components of the market were important in moving the valuations of these companies. And then finally, we'll look at the effect of inflation on infrastructure assets. We'll comment on certain key metrics that should be looked at and how they could differ quite often before we open up for questions. Right, so in the year 2021, the market movements revealed some of very important risks in the infrastructure performance. It's not just that that one component of the performance was important. It was a holistic view that we will take in the next few slides. So first, I wanted to show you this Infra 300 equity index. That's our flagship equity index in unlisted infrastructure equity space. And this is presented on a monthly frequency. This table shows you a summary of risk and return in this index. So for this month, that is December 21, we have a minus 0.2% return. For the quarter, that is the last quarter of 2021, the return was very strong at 4.58%. And over the year, it has done really well with almost a 13% return. On a 5-year basis, the Sharpe ratio remains strong. The value at risk numbers remain quite reasonable. So overall, long-term basis, the index is still doing really well. And in the short term, in 2021, we can say that it has recovered from the shocks that it saw in 2020 period. And now it has performed really well in the last year. Just a note here that this index is an equally weighted paying scheme and is in local currency. And it is available in Bloomberg with the ticker Infra300 if you want to access it. So the performance that is shown is on a total return basis, and it is made up of two components: price return, that is the change in the valuations and how it impacts the return of the index. And the second is the dividends paid by the underlying companies. So you can see that in 2020, the price return was heavily negative. That was due to these large write-downs which happened. Increased premia and the lower cash flows both were responsible for these write-downs, and which lowered the valuations and ultimately caused this negative price return. But in 2021, these valuations have bounced back. You can see that almost 5% of the total return is contributed by the change in valuations. And then finally on the slide, we can see that the cash yield of about 7 to 8% annually remains a very attractive feature of infrastructure equity asset class. Right, so the FX risk was also very important in the last year. And in 2020, we showed you how the movement in some currencies, say US dollar, impacted the performance of the index quite a lot. The index itself is dominated by the British pound and euro currencies. And you can see this split of currencies here on the pie chart. The point is that the FX movements from between different currencies can have a very diverging effect on the index. And in 2021, we saw a significant depreciation of Japanese yen, for example, against the pound sterling and euro. We can see that both appreciated by 10.2 and 3.5% in 2021 alone. So that leads to this the performance variation between the two currency indices. In US dollar terms, the 2021 performance was a bit lower than local currency return. It was about 8%. And in Japanese yen, it has exceeded more than 20% return. And that's partially driven by the underlying valuation change and the cash yield that I was talking about earlier. And partially it's the impact of these FX movements. So when you are trying to understand the performance of any asset class or any index, it is important that we understand the currency split of the underlying companies and how these FX movements between different geographies can cause the variation in the performance and also the risk. If you look at the volatility of these different indices, surely that would be different accordingly how the movements have happened in these currencies. The next thing I want to talk about the interest rate risk. And to demonstrate this, I've taken two weighing schemes of Infra300, the equal weighted and value weighted weighing schemes. The point is to show that the larger assets which have longer duration, they are more impacted by the interest rate movements. And we show it in the form of these two indices. The value weighted index has underperformed an equally weighted version for almost the entire horizons. If you look at it, 5-year period or 3-year period, it has been underperforming the more diversified equal weighted index. And part of the reason lies in this, in these interest rate movements. So for that, we show you this monthly return in 2021 for both the indices. In February and December last year, there were interest rate hikes in most parts of the world. And you can see that the value weighted index dropped a lot more in comparison to the equal weighted index. And that is essentially the driver of this underperformance of one index over the other. So that's another important thing, that when you are looking at an index or a company, it is important to understand the impact of duration, the interest rates, and how it can affect the performance. And accordingly, you start to use that index for your own purposes, for benchmarking or for understanding the impact in the asset class. Right, so here's a snippet of the segment level performance in infrastructure. Now, these are all value-weighted indices in local currency. So I want you to focus on this 1 year total return across these indices. And the point to note is that the segments of the market which were more resilient in the COVID-19 crisis, they have shown smaller return in comparison in the last 1 year as compared to the other segments of the market. And this is understandable because the recovery was much more pronounced in those segments which were more significantly hit in the COVID-19 crisis. But overall, if you see the 10-year return, 10-year volatility, they are all very attractive. All the segments are doing really well. There's some outperformance, obviously, but otherwise, most of the infrastructure segments have done really well last year. And all of them have been in positive territory. So that's obviously a good thing for the asset class. And then on the debt side, the situation is a bit different. So it's I'm showing you an Infra 300 debt index, which is the newly created index on a monthly frequency. This index represents the most recently issued senior debt instruments for the constituents of the Infra 300 equity index. It represents almost 100 billion in market cap, and since inception, it has included almost 1,000, even more than 1,000 individual instruments since inception. So in this 1 year, the return for this debt index was negative. It was minus 0.57%. And this month and this quarter was also in the negative territory. And that's largely the impact of the interest rates that is driving the debt infrastructure market in the negative territory for this year. If you look at over the 3-year and 5-year period, the returns stay quite attractive. The Sharpe ratio is really good, and the value at risk remains quite low for the index. In the second table on the right, I have the average credit spread, yield, and duration metrics for the broad market debt universe in our database. And here, I wanted to highlight this point that in Q4, the average credit spread is about 140 basis points, whereas 1 year ago, it was about 156 basis points. So the credit spreads have shrunk over the year, but then yield to maturity has gone up by almost 70 basis points in last, or 60 basis points in last 1 year. And then you can see the impact is quite clear that even though the credit spreads are shrinking, but because of the increased interest rates, the overall yields have increased across the debt market. And the duration has also reduced slightly from 1 year ago. It is safe to say that the overall trend in the spread and duration has been on a declining trend, and the yields have come back to pre-COVID levels because of this rise in interest rates. Right, so that was the snapshot of the performance in different infrastructure segments and the markets. Now we move on to this universe coverage. Here I wanted to show you this, what our universe is made up of. So it has 25 principal markets, which are selected by the minimum size of the assets in these markets, the secondary activity in the deal making in these markets, and finally the data availability, where we can get the regulated accounts and the information for these companies to be included in our universe. Based on this criteria, we have identified 7,000 investable firms, and they represent more than USD 3 trillion in total asset book value as of 2021. So the overall sample is quite big, and it represents the entire infrastructure market. And from this broad sample, we have selected 650 plus firms and 2,300 plus debt instruments over 20 years for these companies, which are basically used in the creation of the indices, all of our asset pricing models, creation of the analytics, and all of that is based on this sample universe, which is designed to track this overall infrastructure market. How this universe evolved in 2021? So we have added 33 new companies to this broad market universe. And in these plots, we show you the net change by industries, by business model, and by corporate governance. So most of the focus has been on the theme of energy transition. As we move towards renewable companies, we are adding more and more of these companies in our universe. You can see that that's the largest proportion of companies added. They are of contracted type, they are project companies, project finance companies, and they are driving this change in the universe. On the other hand, you can see that the power generation, so like the coal power plants are getting shut down and already or soon to be shut down in recent future, in near future. So these companies are getting removed from our universe slowly. And last year, that was the biggest drop by sector in our universe change. I showed you the performance of Infra 300 index earlier. And here we compare the Infra 300 allocations by, again, the same three ticks pillars, the business model pillar, industries, and corporate governance against the overall universe that I was showing you just now. This is at the time of the index creation, but you can see that the Infra 300 index is a representative of this overall market. And that's how we've been designing these indices, that they should serve the needs of infrastructure investors. Infra 300 index in particular is very popular, and precisely for this reason, because it represents how the overall infrastructure market is doing and performing at any given time. A brief note about our valuation methodology. So the thing is, in infrastructure, private infrastructure, we can't use a comps approach because there are not many similar companies and the transactions happen very rarely. For that reason, we started using a discounted cash flow method that became the foundation of our valuation methodology. And the issue was to estimate the risk premium, because rest of the inputs, the expected cash flows, the interest rates, these can be modeled with the looking at the accounts or the market movements. But the risk premium was the key component of this valuation model. So we came up with this statistical approach where we observed some transactions in the secondary market, and we tried to decompose these observed transactions risk premium into some standardized factors, say size, leverage, profitability, investment, and term spread. These are the 5 main factors, and then there are some control variables. The objective being that all infrastructure companies are exposed to the same factors by different magnitudes. So if we can find the prices of these factors, we can basically value or find the risk premium for any untraded infrastructure equity company out there by applying these factor loadings on these estimated prices. And that's the approach we take. Using this approach, we can find the risk premium for all the companies in our universe every quarter, in fact, every month now. And we basically use these to create the valuations, to calculate the valuations of these companies on an ongoing basis. And then they are added in the index accordingly based on their weighting scheme, whether it's value weighted or equal weighted. Now, having understood this, the discounted cash flow method has 3 main components. It's the expected cash flows, it's the interest rates, and the risk premium. So this has become a very standard approach for us, that we decompose these effects individually and try to understand what moved the valuations over a given period of time. So in 2021, this plot is for the global infrastructure segment. And in 2021 alone, we can see that the largest contributor was the improvement in the dividend forecast, which moved the needle the most for the valuations. And the significant drop was caused by the increase in interest rates. So again, this highlights the interest rate risk and how these long duration infrastructure assets can be impacted by the movement in interest rates and risk premium. Risk premium in 2021 largely remained flat or slightly lower, in fact, and caused a small positive change in the valuations. But if you look at over the last 3 years or 5 years period, when risk premium had increased quite a lot during the COVID-19 crisis, or interest rates had gone down quite a lot, you can understand how they impacted the valuations. Risk premium was the largest contributor to the drop in valuations, and interest rates was driving the positive uplift in the valuations. But in 2021, this trend has reversed as the recovery has kicked in this asset class. Now we can take these valuation drivers and understand it within the individual segments instead of the global infrastructure space. So here we compare the core and core plus segments, and we show this in this table, the comparison of what changed NAV in different periods by the changing in the dividend forecast, or the change in interest rates, or the change in equity risk premium. For these core and core plus companies, it's quite clear that the core plus companies showed a much stronger recovery last year, and bulk of their valuation uplift was driven by the change in the dividend forecast. It was close to 10% change in the NAV just by dividend forecast alone. The interest rate increased partially offset this, this change in NAV, and had a -5% effect in core plus, whereas in core it was much smaller, as they have smaller duration in comparison, and also are less impacted by these discount rate changes, be it due to interest rates or risk premium. But if you look at over the 3-year or 5-year period, the core plus companies were hit much worse. They had -8% and -5% change in NAV just by the increase in equity risk premium. So it's clear that the segments which were impacted a lot more in COVID, they are now recovering a lot better. And we'll keep on building on this theme by different examples later on. So to build on that argument again, here I am showing you the dividend over CFATS ratio in core and core plus infrastructure companies. So this ratio explains how much capability a company has to pay out dividends as a proportion of their cash flow that is available for debt service. So now what we are showing you here is that if you look at the 3-year, 5-year, or 10-year averages, the core plus companies had a mean that is roughly 3 percentage points higher than the core companies. But if you look at the estimates for the next 2 years, you can see that this gap has increased to almost 10%. That is, the core plus companies are expected to have 10 percentage points higher dividend payout as a proportion of the CFATs as compared to the core companies. And this is what I was showing you earlier in the slide, that due to the change in dividend forecast, the NAV change is much larger in core plus companies. Now, similarly, on this theme, if we compare airports and roads, two sectors which were both hit by COVID crisis, but on completely different magnitudes. Airports had a much bigger impact on them, on their valuations. They had much larger write-downs. So here we show that same point, that if you look at the change in dividend forecast and the change in NAV, in airports, it's much larger in 2021. In roads, it's much smaller. Similarly, airports have longer durations. So they have bigger change in NAV due to the interest rates changing. So interest rate risk is much larger in airports as compared to roads. And finally, if you look at the 3-year and 5-year averages, the airports had suffered a lot more. They had write-downs of up to 18% on average, whereas in roads, it was between 5 to 7% over the 3-year and 5-year period. So they, again, these airport companies, they had a much worse 2020 year, and because of the crisis, and now they are recovering a lot better than roads. We can build this argument again looking at the financials. So here I'm showing you the revenue growth in airport and road companies. And again, if first you look at the 3-year, 5-year, or 10-year mean in both tables, you will find that the airports had a much worse past in the last 2 years. They had a revenue growth of up to 16% lower in the last 3 years. Whereas if you look at the estimates for the next 2 years, airports are expected to do a lot better. Their revenues are expected to grow at more than 40% as compared to about 9% in road companies. So clearly they have a stronger recovery estimates, and they are expected to bounce back from this downturn in 2020. Now we compare the contracted versus merchant companies. So The theme again remains the same, that the contracted companies were more resilient in COVID crisis. So obviously they have a much smaller recovery in comparison, but the magnitudes are quite drastic. That the merchant companies have up to 10 percentage points higher change in NAV just by the improved dividend forecast in 2021 as compared to contracted. Similarly, I wanted to show you the 3-year and 5-year average and the equity risk premia table. So the merchant companies had much larger write-downs, more than 8% in the last 3-year and 5-year average, whereas contracted had about 5%. So their equity risk premia had increased a lot more in merchant companies, which had caused these larger write-downs. And now if you look at the 1-year average, the merchant companies are recovering a lot better. So by the change in equity risk premia, their valuations have improved by almost 3%. And I'll come on this point again, and I'll show you a time series of how these equity risk premia have evolved for the two segments. But before we do that, I also wanted to show you these financials of dividend over revenue ratio in the two segments. So if you look at the average of last 3 years or 5 years, you can see that contracted companies were paying almost the same mean as proportion of their revenues. Their mean dividend payouts were almost the same or higher than merchant companies. But now if you look at the estimates for the next 2 years, these dividend payouts are estimated to be much higher for merchant companies. It's more than 14% percentage points difference between the two segments. And that's largely due to this recovery from COVID and also the inflation expectations that have kicked in, which are leading to these improved dividend forecasts for merchant companies which have better pricing power. Now I was talking about these risk premia in the two segments. So here, if you see from 2015 to 2019, the risk premia in the two segments were quite stable. For merchant, it was about 800 basis points, 750 to 800 basis points. And for contracted, it was between 500 to 600 basis points. But then in 2020, the risk premia in merchant companies increased a lot. It increased more than 100 basis points. And now in 2021, you can see that it is slightly coming down. It is on a downward trajectory, whereas for contracted, it has stabilized around 650 basis points. So this is what I was referring to earlier when I was showing you this last 1 year average change in NAV. Contracted is almost flat, 0.3%, whereas for merchant, you can see that it's a 3.2% change in NAV just by this change in equity risk premia. So risk premia is going down and the valuations are improving in these companies. Right. So finally, I also wanted to cover a few points on this topic of inflation. It is quite relevant in the current scenario, and everybody is concerned with how inflation moves the infrastructure assets and what impact does it have. So here we wanted to show you the linkage of inflation with revenues and dividends and how it can work differently in different segments. So in this plot, we have computed the revenue growth and inflation. So it's a difference of revenue growth and inflation by the three business model types: contracted, merchant, and regulated. For this analysis, we have taken the data from 2005 to 2020, and it includes 500 plus companies, which are 10 years or more of their age. That is, they are mature companies. The point is to show that does the revenue growth in these companies on average beat the inflation rate in those countries where these companies are based? And you can see that you have the distribution of companies on both sides of this line. So the center means that they are exactly at the same level. That is, the revenue growth is exactly at the same level as the inflation rate. But you find that the distribution of companies is on both sides. That is, some companies have revenue growth that beats the inflation in those years, whereas some companies are underperforming that average inflation rate. If you see the median, that is the center line in these box plots, for contracted, it is close to zero. That is, on average, all contracted companies have the same revenue growth as the average inflation rate in those countries. Whereas if you compare merchant versus the regulated sectors, you'll find that the medians are much higher. That is, the median revenue growth in merchant companies beats the inflation rate in those countries. And similarly, the median revenue growth in regulated companies beats the inflation rate in those countries. The point is that the magnitudes are quite different. The merchant segments or the merchant companies have a much larger revenue growth in comparison, and they beat the inflation quite more often. Whereas in regulated companies, it's much smaller. But if you look at this by dividends in this plot, the situation is not the same anymore. So earlier we were showing you the revenue growth and inflation rate comparisons. Here we have the dividend growth and inflation rate comparison. Here, the contracted companies have a median that is in the positive territory. That is, on average, the dividend growth in contracted companies beats the inflation rate as well, in merchant companies as well, but regulated companies perform the best out of the three business model types. That is, and the point that is coming out of here is that if one segment or one company has a higher revenue growth than the inflation rate, doesn't mean that it will have a higher dividend growth as well. And that's the key thing to focus on, that you need to look at the underlying characteristics of the companies and the different dynamics in their financials before you understand that inflation linkage at a revenue level is quite different from what you will see in the realized cash flows eventually. By this example that we have taken here for this illustration, it means that the regulated company should have the best outflow of dividends or best dividend payouts if you compare them by the inflation rates. Whereas in this scenario, even though merchant companies had the pricing power, whereas the regulated companies only have these partial pass-throughs, they still outperform, they still beat the merchant companies in terms of the dividend payouts eventually. Right, so at this point, I'm going to launch this poll where there are these two questions. First question is, will infrastructure valuations keep on rising in 2022? And the answers can be yes, all infrastructure sectors will rise, yes, but only in certain sectors, or no, they will maintain the current level, or no, they will decline. So I'm starting the poll now, and I want to know what our audience thinks about this question, that what will happen to the valuations? We have seen a dramatic trend in the past 2 years where the valuations have gone down when COVID hit, and now they have partially recovered. But pre-COVID, they were quite stable, as I showed you in some of the risk premium plots. So it is important to know now what will be the future trend. And we have some estimates in terms of the expected return or the movements of interest rates in different scenarios that I showed you. But this is a consensus from the audience that we are interested in knowing as well. Right, so we are getting some good participation. It's more than 60% already. Let's see, let's give it a couple more minutes before we close this poll and move on to our second question. Right, okay, so it's approaching 70. Okay, I'm going to give it 20 more seconds if there are any last minute responses. All right, so I hope we can see the results. So here are the results. Will infrastructure valuations keep on rising in 2022? Close to 70% of you think that yes, but only in certain sectors. And I sort of tend to agree that some sectors which have seen really large valuation changes in the pre-COVID period, it may not remain the same for these sectors, but then there are different dynamics kicking in now, different sectors are in focus. So these trends will change, obviously. And also the impact of interest rate and risk premium will also define which sectors, which segments of the market will see the valuations uplift. Surprising, 20% of you think that yes, all infrastructure sectors will continue to rise. I didn't expect that, but that's interesting to know. And very few of you think that no, they will maintain their current level, or no, they will decline. Okay. So these are interesting results. And now we move on to our second question. Let me launch this poll. And this is again, one of the most pressing questions today in infrastructure segment, that is it always an inflation hedge? I've shown you that there are companies on both sides of the spectrum, that there are companies which beat the inflation rate, and there are companies which don't. It depends on which segments of the market you look at, what are the underlying dynamics. And then also, it depends on whether you are looking at which financial metric. The revenue growth beat over inflation is one thing, but will you eventually realize it in terms of dividends? That's another thing. So yeah, we have 60% participation in this poll already. Going to give it another 15 seconds to see if we have any more responses. The trend is coming quite clear on this one. I'm not surprised to say. All right, so we have about 70% participation on this one as well. I'll end the poll and share the results with you. So majority of you think sometimes it depends. And of course, I agree, as I mentioned, that it depends on which companies you are looking at, what are the underlying dynamics in the contract and so on. And then also which segments of the market you are looking at. Some companies will beat the inflation, obviously, but some companies in terms of their growth of dividends or growth of revenue may not do so. Right, so this was a very clear result, and 0% of you think that there is no inflation hedge, never. Yeah, that was a pretty strong option anyway. So that's quite clear. Right. So in terms of the final key takeaways now, I've talked about performance in 2021. We can call it as the post-COVID recovery for infrastructure equity. The performance has bounced back. Obviously, we have seen it through different lenses, by looking at the impact of FX, by looking at the impact of interest rates and so on. But overall, we know that the year was positive for infrastructure, and the asset class did well, at least on the equity side, whereas the infrastructure debt suffered a bit due to these rising interest rates. And I tend to think that in 2022, as we are expecting more interest rate hikes, we could see something similar, at least for infrastructure debt, where it will continue to be impacted by these interest rate increases. The recovery was much more pronounced in the COVID segments. Of course, we showed you that the segments which were more susceptible to this COVID lockdowns and stuff in 2020, that is the core plus segment of the market, or merchant companies or airports, for example, these companies are now doing a lot better in 2021. We have seen their performance comparisons. We have seen the improvement in their dividend forecast, and they are expected to continue to do better as they recover from these downturns in the next couple of years. But having said that, there are risks in all investments, obviously, and in infrastructure, we have realized some of these risks last year. We have seen that the FX movements can be quite drastic, and they can lead to very divergent, huge divergence in the performance between different currency of the indices. And also, we showed you that the interest rate risks are quite clear by the demonstration of the different weighing schemes. The larger assets which have longer duration are more susceptible to these interest rate changes, and they are more impacted in terms of their valuations. Then we saw the valuation drivers, and we saw that the changes in NAV due to the improved dividend forecast, it was partially offset by the impact of the rising interest rates. So because the interest rates rise had a negative impact on the valuations, we couldn't fully see that improvement in dividend forecast directly translating into the valuation uplift, but it was partially offset. And finally, I showed you this inflation comparison in revenue growth and dividend growth charts. And we can say that now that this asset class is faced with higher interest rates, all infrastructure companies are not going to beat inflation. They exist on both sides of the spectrum, and some may beat inflation in terms of their revenue growth, but it may not realize in terms of the expected dividends eventually, or vice versa, that they may not have a strong revenue growth, but they can still afford to pay out a lot more in comparison. So eventually I leave you with this question that 2020 will require careful risk management. We have seen these risks realize in 2021, and if anything, they'll be a lot more pronounced in this year. So are you aware about these risks in your portfolio? And if not, then you should check out our platform. It can help you understand some of these risks and how to assess this asset class further. So that's pretty much it from me. I'm going to take questions now. We have some questions in the Q&A block. If you have some more questions, then please feel free to write in there, and I'll take more questions. So one question is, the negative change of equity risk premia over the past 3 to 5 years looks important. Could you elaborate on the performance drivers, please? Seems surprising given crowding in markets. Yeah, so the negative change in the equity risk premium over the past 3-5 years is largely due to this jump in the COVID period in 2020. I showed you that in the case of merchant and contracted example, where I was showing you a timeline of this equity risk premium, it has increased quite dramatically in the last 2 years. It has increased by more than 100 basis points in merchant companies, and that's what drives this change. And finally, it has started to recover now in 2021. There's a question on which type of infrastructure companies do you expect to beat inflation in 2022 and further? I mean, that's a very hypothetical question in my mind right now, because what we have seen evidence is that different companies have different types of characteristics. We showed you that the regulated companies are best placed to beat inflation looking at their historical data. They have beaten the inflation in terms of their dividend growth in the past. And they have these partial CPI pass-throughs which help them to do this. Whereas merchant companies, on the other hand, can beat inflation quite strongly in terms of their revenue growth. That's also something that we showed you in terms of the historical data, because they have this pricing power. But then ultimately, there are many elements in between, how the capex will change, what will happen to their debt service and so on, before you can think about the expected cash flow that will come out from these companies. So yeah, I mean, this is a very important topic, and it is also an important priority for us to look in this year, and we'll do furthermore series of webinars later this year to cover this inflation topic down the year. What asset class does the performance cover? Is it debt only, equity only, or combination of both? Is it global or regional specific? So the asset class covers both equity and debt in infrastructure space. And I showed you the performance of these different segments separately. So infrastructure equity has performed very well last year, whereas infrastructure debt has suffered because of these rising interest rates. And it is certainly global. We have a wide universe which covers more than 25 principal markets. So it is spread out across the world, the infrastructure company that we have included in the universe. Regional specific, is there infra cover for Africa? Okay, that's a follow-up question. So Africa, we don't have much in our universe at the moment, because the secondary activity historically has been a bit less in this part of the world. But eventually, as the secondary market activity picks up, of course, we will tend to focus more on including more and more data in our universe. That is definitely something that we keep track on and we continue to monitor. Right. So there's a question, how do you define these core and core plus segments? Right, so that's an interesting one. And it's one of my favorite questions as well, because there's a lot of debate around these segments. What is core and core plus? I know a lot of you would think that a lot of you would define these by different sectors or different geographies and so on. But what we thought of is the most transparent way to define these is by looking at the expected returns in these companies. So I have a appendix slide on this, if I can show you. Hold on, this one. So we created a distribution of the expected returns over the past 5 years, and we divided the distribution to call a particular segment as core, core plus, and opportunistic. So up to a median expected return of this distribution, we define as core. Then from the companies in the third quartile of this expected return, we call them core plus. And the companies in the top quartile of this expected return, we call them opportunistic. So this becomes a risk-based approach rather than just calling one sector or the other as one of these segments, because even within one segment or within one company, there are different stages where the company can move from core plus to core to opportunistic or whatever, depending on what is happening in the life cycle. And we wanted to cover all these aspects. That's why we took this risk-based approach, and it makes it also transparent to understand in terms of what's happening in the market and how these risk factors drive these segments. Then there is a question on, has there been significant divergence within subsectors? Example, assets benefiting from feed-in tariff style subsidies or contracted availability between concessions versus shadow toll contracted revenues given investor demand for stable inflation-linked yield. I mean, we have clearly seen the divergence in the subsectors. I showed you the example of the business model, but we can also split it down further. The point is to show that, it's important to understand what type of, you're raising a good point here, that whether it's a feed-in tariff style subsidy or it's a contracted availability, what's happening, because it's important to understand these characteristics. So even if we look at segment as a whole, what we showed you, contracted or merchant, within these, the companies are of different types. The contracted revenues could be fully contracted or could be partially contracted. Anything can happen. And it's important to understand these characteristics before you look at how they beat the inflation. And as I mentioned, that this is an important topic for us for this year. So we'll continue to do more and more analysis on this topic and understand these impacts in these subsectors. Then there's a question on what type of infrastructure company, or this one is done, sorry. In respect of debt finance, supporting infrastructure transactions, how will the current interest rate and inflation situation in Europe impact on the dynamic of debt being provided to the sectors between bank versus institutional investors? I mean, most of these infrastructure transactions, I mean, they are project financed, obviously, so there's a lot of private financing going in. And the interest rates on the rise, we see that the spreads have shrunk, so there's a lot of competition that is happening in this space. The spreads are really low at this point. And so what I can imagine is that it will just add more and more competition between different types of investors in this asset class. And that is going to continue as these interest rates keep climbing up. I think this market will get even more tough overall. That's all I can say about this question. Then there's a question on what is the expected scenario on which the growth forecast of 40% for airports is based? Is the assumption in that scenario that there will be no more substantial negative effects of current or potential new COVID viruses on the segment? Yeah, I mean, partially that. And so we looked at the realized data for the companies which have reported their accounts in 2021. And this is what we are seeing, that while in 2020, because of the lockdowns and so on, their revenues had dropped a lot. In 2021, the same companies have started reporting better numbers. Their financials have improved. And the overall approach in the market is also that there are going to be, there are expected to be fewer lockdowns in future. So all that has gone in creating this 40% revenue growth in the next couple of years. And mind you, that's based on a lower number already, because the base was already lower in 2020. So this 40% growth is on top of that base. So partially it's the recovery, and then partially it's the revenue growth that they would have seen had there not been any crisis. So it's an effect of both. Right. So there's a question on cash flow forecast, that how do you do the cash flow forecast in these companies? So that's a related question to this, the previous question on revenue growth. So cash flow forecast intrinsically is a statistical model as well. I talked about the valuation model that we have, but on the cash flows as well, we have a life cycle based statistical model, which we use to create these cash flows for all the companies. But there is also this element of analysis that goes in, depending on which sector we are analyzing, which geography we are analyzing, and so on. We have a team of about 10 analysts who do this, and they create these revenue growth assumptions for these companies, looking at these markets movements and market situations, and that revenue growth becomes an input to this cash flow forecasting model that is essentially used in the valuation process as well. When we put infra into small, mid, and large segments, where do you see more opportunities in terms of cash income and also price appreciation? Well, cash income is something that is on a global level. We see that overall asset class has a very strong cash yield. But if you split it by size, it could vary by which type of business model that you are looking at, because same type of companies, say contracted companies, could also vary in terms of their size. So it's not really as straightforward as just segmenting this market by size and trying to understand where you can find better income or appreciation. It's also to understand these, what we call the ticks classification of these companies, before you can understand how these income and appreciation vary. But if you are a subscriber to our platform, then you can see all these price and cash return variation in these different markets, different segments, and you can try to make an assessment of which type of companies you are looking at or you hold in your portfolio. Then there's another question on, are there differences in risk premia or changes in premia between regions, or does your methodology not allow you to identify these? So the risk premia changes are there for sure between geographies, and we capture it. There was a slide where I showed you the factors that go in the risk premia modeling. There are some sort of microeconomic factors like size, leverage, profitability of the companies, and so on. And then we have a term spread factor, which tries to pick up this geography effect to some extent, that where the interest rate spread between the long term and short term is quite large. These companies, these geographies tend to behave differently in terms of their risk premia, and they have different loadings. So ultimately their risk premia turns out to be different. And it's also that the transactions that we observe in the market, we take in from different parts of the world, and accordingly they influence the valuation process as well, as in which sectors are more prominent in which geography and how they impact the risk premia. So there are obviously several differences in the risk premia as well between different regions. How is ESG-oriented pension fund regulation, example, task force on climate-related financial disclosures impacting valuations? So this is an important question. I mean, we haven't really gone on the ESG track yet, but there is a research program going on at EDHECinfra, which is to create these ESG ratings for all the infrastructure companies. So eventually we will also start to look at these things, that how the climate related financial disclosures, like you mentioned, they impact the performance, and we can segment them by different ratings of ESG performance and so on. So that's on our list, and it's one of the goals of this research program that is currently going on. Would you know why the maximum drawdown of opportunistic funds was lower compared to core and core plus? So this maximum drawdown was computed over the last 10 years. And as I mentioned, that the approach of creating these core plus or opportunistic segments is based on the expected return. So it may so happen that those companies which saw these large drawdowns, they have moved on in terms of their life cycle, or they may have realized better returns over time. Whereas opportunistic funds, they have seen smaller drawdowns in the past, but they've performed really well. We see the segment as a whole, it has outperformed the other two core and core plus segments. So it could also be because the companies don't stay in that stage for long as they become mature and they change their buckets to say as they reduce risk in their financials or in their performance. I think there is one more question. Thank you for, okay. In Europe, there is progress to recognize nuclear as green energy. Do you think private capital could be interested by such projects? I don't know whether what kind of private capital could be interested, but surely if that so happens, then we have this TICS consultation that we run every year, and we would look into it. If there is a strong interest from the market, then we will definitely include it as part of our TICS classification, and we'll start to include it eventually in our universe as well. But that's something that we'll have to wait and see. All right, I think we are almost out of time. There's one more question that probably we can take. What is the share of the US in the Infra 300 index? In the universe, Americas was shown with about 20%. However, previous slide showed that Infra 300 index has a very small allocation to USD. How important is the US for the Infra universe in general? Yeah, so that's something that is currently lacking in our universe. Infra 300 is not the only one, but in our overall universe, I mean, the problem is not that the infrastructure is not important there. Obviously, the trend is there, and infrastructure assets are very prominent in the US. So as a whole, we have this initiative now to increase our coverage in the US. Historically, it has been a bit more difficult for us to get data from these US companies, but now we are pursuing several avenues to increase this data coverage. We are partnering with different contributors to increase this data coverage as well. So the goal is basically to match that universe coverage that you saw, about 20%, also in our indices and our overall universe. That is certainly one of our goals. All right, I think we have run almost at time now. So thank you very much for attending the webinar. Hope you found it interesting. And we can't wait to see you again in our next webinar. Thank you.